So what I wanted to talk about is overpaying your mortgage in a high interest rate environment. Now, ultimately, if your mortgage is higher than the rate you get on savings, then the conventional wisdom is that it pays to overpay your mortgage. It makes financial sense. That's because you pay less interest in the long run and you actually can reduce the number of years it takes to pay off your mortgage. We looked at this in detail on episode 219 of this podcast. So we're going to link to that in the notes of this show. Listen to that show because we talk about the things to consider before you repay your mortgage. I don't want to dwell on that. As a summary, if you're thinking about overpaying your mortgage, you need to make sure that you have a cash buffer in place first for any emergencies, but you should also pay off any high interest debt that you have before you think about overpaying your mortgage. Also, check for early repayment charges that may be in your contract. You don't want to incur those. And also stay within any limits that you have on overpayment. So a lot of mortgages will have a 10% limit. So 10% that might be outstanding on your mortgage at the start of the year, for example, you're allowed to pay that off without incurring any early repayment charges. So a typical question that I'm getting from people is that they might be in a fixed mortgage that may have been a 5-year fix. They may have 2 to 3 years left to run before they have to remortgage. Are they better off now overpaying that mortgage ahead of them remortgaging in, say, 2 years' time? So if you've been listening to this show, I've been talking a lot about this scenario, preparing for rates going up when you come to remortgage. And I've been doing that myself, and I've actually been putting money aside. That's one potential solution that you have. But I want to explore this overpaying idea in an environment that we've got now, because we've always talked about high interest rate environments. Then it does pay to overpay your mortgage. It does make sense. We're in one of those now, or you're going to be heading into one of those environments when you come to remortgage if you're still on a low rate. If you overpay your mortgage, then what it can do is give you a better loan to value. So if you're on the cusp of a loan to value threshold, so typically lenders will look at thresholds of 90%, 80%, 75%, 60% loan to value. And depending on which band you land, then you can get a better rate. The lower your loan to value, the better rate you typically get. So let's say, for example, on a 2-year fix right now, you'll get about 5.64% if you've got a 90% loan to value. If you can drop down to 80% loan to value, you can get 5.34%. If you get a 75% loan to value, you get 5.29%. A 60% loan to value, you get 5.27%. So you can see that by overpaying your mortgage, you could actually get a better loan to value, which means that you will be paying less a month on your monthly repayments. So that is obviously attractive. So obviously rates change regularly. That is just the rate I'm giving you as of today. Now, you can obviously overpay your mortgage within certain limits without incurring an early repayment charge. I mentioned earlier on a typical 10% of the amount that's owed at a given point, let's say the 1st of January, without having to pay that early repayment charge on your mortgage. So look at your terms and conditions. It's going to be specific to your mortgage what you can overpay. If you do overpay, then obviously, like I said, you can reduce the length of your loan, so reduce the term, you pay it back sooner. So logically, overpaying your mortgage does make sense in the long run. One thing to bear in mind, that if you do overpay, then often you won't be able to get the money back from the lender. It used to be the case there were mortgages around that were more widespread, nationwide, used to have a product where if you overpaid on a mortgage, you could actually borrow it back again. And I only know this nationwide because I actually had one of those mortgages in the past, and they were one of the few lenders that actually had that option. Now, while most lenders won't allow you to borrow money back that you've overpaid, there are some lenders. Virgin have a range, for example, of fully flexible mortgages. And if you look at the T's and C's on those, they have options that include overpaying, underpaying, borrowing back money that you've overpaid. So if you've got one of those products, check. You may have more options when it comes to overpaying that will influence your decision on whether you want to or not. There are some lenders that do offer the ability to underpay if you've overpaid in the past. That's something to bear in mind, but you've got to talk to your lender and actually work out the impact for you, because you want to make sure it's not going to have any impact on your credit file, for example. Although, as we mentioned on last week's podcast, there are new rules that have come in. We'll put a link in the notes of this show with a full explanation of those new rules that have come in as a result of the high rates that we've got in mortgages that the government has put pressure on lenders to allow people to temporarily make changes to their mortgage, so increase the term or reduce their payments by going on to interest only, for example, without it impacting their credit file. The one thing I will throw out there, that charter, as it's called, has actually only been signed by, well, most lenders, but it only covers 85% of the mortgage market. So it does cover the main lenders out there, but you can look at a list of the people that have signed that charter. So it might not include your lender, but you want to have a look at that. We'll put a link in the notes of this show so you can have a read through. So one tip, if you are going to overpay, make sure you tell your lender that you want the overpayments to reduce the term of the mortgage rather than just reducing the amount you're going to be paying going forward each month. So there you go, that's overpaying. And as I said, you can go listen to that past podcast, and we have got links to articles in the notes of this particular show. So we'll put aside the long-term benefits of overpaying. There are people out there who are raising the question in relation to what's going to happen in a couple of years' time when they come to remortgage. Is overpaying worthwhile? So I've run through some numbers for you just to give an illustration. So it's going to be different for individuals, but if, for example, you are on a low mortgage rate because you fix maybe for 5 years, let's use a 200 grand mortgage as an example with a 1.2% interest. So you've got a lot of equity in your house. So you had a good loan to value when you took out that mortgage originally. And that would mean that your monthly mortgage repayments were about £660 a month. So in a couple of years' time, let's say 2 years' time, you're going to have to remortgage. And let's say you're going to go on to another fixed rate deal and you're concerned that your rates are going to jump. So let's use the current rates that you can get, 4.7%. The Bank of England said this week that rates were going to be higher for longer in terms of the base rate. If that's the case, then let's assume mortgage rates are going to be about that level in 2 years' time when you come to remortgage. Now, if that's the case, when you come to remortgage and you were getting 4.7% for your interest rate on that new mortgage, you would be paying £1,010 a month. So £1,010 a month compared to the £660 a month that you're paying now. That is a £350 a month difference. So that might be quite a bit. Let's assume you can pay £200 a month now overpayment on your mortgage to try and bring it down because you want to reduce your loan so your monthly repayments are lower when you come to remortgage in 2 years' time. I worked out the impact of that with a number of different calculators, which we will include in the notes of the show. If you do that, and let's assume rates are still where they are now, they've not gone higher or lower, 4.7%, then your monthly repayment after all that effort will reduce to £985 from that £1,010 number. That means there's going to be a £25 difference after all that effort. So you will have overpaid by £4,800 over that 2 year period, and the net result when you come to remortgage will be that you will have a lower monthly repayment of £25 a month. Now, if instead you put that £200 a month in a savings account, that would mean that by the end of the term, you'd have £4,800 in a savings account. So over the next 2 years, £4,800 plus some interest that you're likely to get. Don't forget, you can get some decent rates on interest now. You can get more than 7% in some cases on regular savings. So you would then have that amount of money sitting there. What you could do is, if you're worried about your mortgage going forward and you want flexibility, you could, in theory, get to that remortgage date in 2 years' time. Your new mortgage will be that £1,010 that I mentioned, but you could then take £200 a month out of your savings pot automatically to subsidise your monthly mortgage payments. What that would mean is, rather than pay £1,010 a month, you'll be paying £810 a month. Now, that is a significant difference, but it means that you'll only be paying £150 more than what you currently are on your cheap deal. So that $660 a month, your mortgage will effectively in 2 years' time rise to £810 a month, which is different to the £1,010 it could be. But all along, all you've been paying is £200 more a month because you've been putting that in the savings account. So, okay, your $660 that you're paying now, you'll be paying $860 a month for the next 2 years. But you will then be paying £810 in 2 years, for 2 years if you fix for 2 years. So that means that you will feel like your mortgage has actually fallen by £50 a month in 2 years' time. Now, of course, this is a short-term flexible plan that might help you, and in 2 years after the next remortgage, so in 4 years time, you're going to have to remortgage, and it could be a very different world, and you're kind of putting the pain off. But what this is doing is helping you cope with a new world of rising interest rates by subsidising it over time. This is effectively the plan that I talked about on the podcast last year that I put in place to help me moving forward with higher interest rates on my mortgage. You can see what you're doing is increasing your mortgage payments, living in a world that is reflective of a higher interest rate world now, but by doing so, you're softening the pain in the future. So in 4 years' time, you might be hoping that rates will come back down again and then your mortgage will start to fall. Yes, overpaying is the best strategy long term because you're reducing your debt in a high interest rate world. But what I'm doing here is giving people another option where they could potentially ease the short-term burden and pain that they might go through in 2 years' time. And these numbers are based on a £200,000 mortgage over a 30-year term.